Welcome to Smart Women Talk. This is your host, Katana Abbott. I'm a midlife millionaire coach and a certified financial planner, and I search the world for smart women and a few good men, including best-selling authors and thought leaders who are on that leading edge. So join us for conversations on money, business, health, and inspiration so you can live with more purpose, passion, and prosperity. Hello, everyone. This is Katana Abbott, and I want to welcome you to Smart Women Talk. Today, we're going to be talking with CPA and personal financial advisor, Wayne Titus, about the financial steps to take before the end of 2022. Now, this is something that people usually don't even want to deal with. They don't want to have to talk about this. We're going to make it fun as possible, and we're going to keep it easy to understand. But this is so important to deal with your money. And it's part of what we've been trying to do this whole quarter is talk about reaching your year-end goals. So how you handle your money is one of the most important things you can do in your life. It's going to affect every area of your life. So let's be proactive because we're all about being smart women, right? So we're going to talk about income planning to take advantage of the 2017 tax cuts that are set to go away. We're going to talk also about what to do to make sure you've withheld enough taxes for this coming year, and deduction planning to help you avoid a higher tax bracket. And then we'll also talk about required minimum distributions, or RMDs, for those that have actually reached age 72 this year. So first, let me tell you a little bit about Wayne. He is a returning guest. He's been involved in the financial services industry since 1991. He served as a founding partner for AMDG Financial and AMDG Tax and Accounting from 2002 until he joined Savant in 2021. He is a certified public accountant, or CPA, and earned his personal financial specialist credential, and he is an Accredited Investment Fiduciary Analyst, which is an AIFA. He is the past chair and member of the Michigan Association of Certified Public Accountants Financial Literacy Task Force. So I believe that's the MICPA, and I'm a member of their elder care task force in the MICPA, and it is a very important program that does training for the education for the CPAs, but a lot of advocacy for the community and financial education. It's a wonderful group. I need to share this with you that today's discussion is intended to provide general information to please consult your financial professional for guidance on your unique situation before implementing any of the ideas presented. Savant Wealth is a registered investment advisor with the SEC, and you can visit www.savantwealth.com for more information about the firm. So, Wayne, welcome to Smart Women Talk. I'm so excited to have you here to talk about financial planning, estate planning, and what we can do before the year end.
Well, thanks for having me, Katana. It's a pleasure to be here, and I'm looking forward to covering these topics with you.
I am too. And this is a totally different topic than the last time that you were here. We were talking about the employee benefits and, enrollment programs at work. But today, what we really want to talk about is what are the things we need to do financially before year end? And why is it even important to have a meeting with your advisor and to review your finances, your taxes, your financial planning? Why is it important to do that before year end?
Sure. Finances is probably one of the biggest areas in life as far as stress for individuals and in married couples. And, there's only one thing that probably eclipses that, and that's when you start talking about taxes, right? Nobody wants to talk about taxes. Very few people are really comfortable talking about finances. So we want to cover just a couple things to try to smooth that process out and reduce that stress at year end. I think it's first a great time to get organized and determine, secondly, if you're working with the right advisor. But to get organized, I think the most simple way is to have two folders, one that's going to take regular tax documents that come to you formally after the end of the year. And the other one is to gather the supporting documentation that you need for tax prep at the end of the year, but that you have right now. The formal documents don't come till after the end of the year, but you have most of the supporting documentation that you need right now, and we'll have it then through the end of the year. And by gathering that information now, you're taking all that pressure off of you at the end of the year, and you reduce the chance that you're going to miss something in your tax prep. And of course, if you miss something in your tax prep, you're going to have potentially higher taxes or a missed opportunity. So getting organized now actually helps you smooth that stress or reduce that stress towards your end. So I'd say start soon. Gather that information, look through your files. If you've had charitable contributions that you've made, make sure you have acknowledgement letters of the receipt of either the check that you wrote or the credit card payment that you made. Gather all of those things and see where those holes are. It also then gives you the opportunity to identify other areas of opportunity that you might have missed or that you might miss if you wait till after the end of the year to get organized. Have you made your IRA contributions? Are you on track to maximize your 403b or 401k deductions? Are you eligible to make an HSA contribution, and have you done that? These are other planning thoughts. And then finally, are you working with the right advisor? Most tax advisors are compliance oriented, and they're only going to be preparing your tax return, but they may not be talking with you about strategic planning, which is looking forward, 20 to 40 years. And in my view, that's really the only way to minimize the impact of taxes in a greater way than just taking these deductions at the end of the year. Those are important, but in the grand scheme of things, it's the tax that you pay over time that matters, not what you save today.
Yeah. Yeah. And I know, even so, my husband is one of these people that uses Quicken. Soon as he, when I go shopping, he gets a text, right? He checks the first thing in the morning, looks at all the bank accounts. He doesn't have to hire a service to monitor anything, but he records everything. So he's super organized and can do a printout. But can you share an idea? And I think you hit on it, but for people that are more big picture and they don't want to have to get on a computer and enter everything. What is the best way? Is it just having a folder, like have these two folders out and when you come back, have a special, I have like a horizontal file, and I throw all that stuff in the top shelf. And then on Fridays, I look at it and I'll put it in the right folder. And at least I'm putting it all together for the person who's going to be doing the bookkeeping. So I'm never looking for things that way. What else do you suggest? And is that a good idea?
Yeah, I'm a CPA, and that's the way I take care of it. I have two folders in my horizontal file drawer. On January 1st, I create the next year's two folders, and I always have them in there. So when I have a document that I know is going to be impactful for taxes, I put that in there. If I have an HSA, and I have a separate folder for HSA, basically medical receipts that I can use to get reimbursed from my health savings account, I have a third folder that I have for that, but at least two folders, one for the formal tax documents that you get, after the end of the year, that you'll need to provide to your tax preparer. Because if you're not really doing this yourself, you want to be organized and you want to evaluate that before the end of the year so that you have that opportunity to evaluate. Are you working with the right advisor? And are you going to be in a situation where you may owe taxes and need to make an estimated payment by, say, January 15th? So there's a lot of reasons to be organized. And I think the easiest way is really just that two folder system. Have it ready and just put things in there. And then you never have to think about it until you're ready to review things, like about this time of the year. And when you're ready to have it prepared, when you take those two folders into your tax preparer.
And then you can block some time out, get it all organized for the tax preparer, and you're going to feel so smart.
Really, you're going to be organized. Literally, I have clients that do this, that at the end of the year, when they're ready to bring their stuff in, they just pull the two folders out, bring them in, and hand them to us.
Oh, you organize it. Good.
Well, in essence, if you organize it in those two folders, it's very easy for us as tax preparers then to kind of finalize that organization in preparation.
That's great. That's great. Okay, so see, we're going to make it simple. There's something called the 2017 Tax Cuts and Jobs Act. And I want to talk about that because there was something that happened that brought our tax rates down, but only temporarily. And so these tax benefits that we're getting, the lower tax rates, they're going to sunset, meaning they're going to go away. So can you talk about that and maybe something that someone who might be in a higher tax bracket or a lower tax bracket today, what they should be considering and why it's important to do the planning now before the tax rates go up?
Sure. Well, no one likes to pay taxes, and people may think today that our tax rates are still very high, but the bottom line is, historically, they're at one of the lowest rates that they have been in a very long time. And those rates are legislated to go back up in 2026. So at the end of 2025, those low rates will end and you'll go into a higher tax bracket automatically. Congress does not need to make any changes. Those rates go into effect in 2026. And so it'll move, the 22% tax bracket to the 25% bracket, the 24% bracket to the 28% tax bracket. And they're going to insert another tax bracket that used to be there. And the rates in the other brackets are going to go even higher. So ordinary income is going to be taxed at higher rates after 2026. That's if Congress does not make those changes permanent. I don't believe that they will make that permanent. This is my opinion. But, if you think back to all the aid that went out during COVID, we had aid for individuals that went out. We had aid for businesses that went out. More recently, we've had a lot of aid that's gone to help in Ukraine, as well as other expenditures. We've continued to spend money at higher rates because of the circumstances that we've been in. And so I find it unlikely, because those deficits have gone up, that we will keep that lower tax rate and make that permanent. I suspect they're going to just let it float back up because nobody in Congress has to take credit for that. They can blame the folks back from 2017. But those rates are going to go up. And there is other areas where rates could go up. Capital gains taxes are not legislated under the 2017 Act to rise, but they almost went up 2 years ago when Congress met and they were talking about raising taxes on capital gains property. So there are changes that could happen, but ordinary rates are going to go up in 2016 anyway. The only way that you can strategically tax plan is to take the opportunity of having low rates now and maybe pull some of that income forward, get taxed on that now at a lower tax rate, because if you take that money out in the future, you may actually be paying a higher tax rate.
That's where we talk about things like taking part of your IRA and rolling it into a Roth and paying the taxes. Would that be a good thing to do at this point?
Yes, it very well could be.
I mean, maybe I'm saying.
Yeah. So if you're in a certain, if you're below the upper level of the 22% tax bracket or the 24% tax bracket, if you pull the income forward, it may push you up to the top of the 22% or the top of the 24%. You don't probably want to go much higher than that, because if you go over 24%, you're in the 32% bracket. So that's a big change. So you definitely want to stay below 24%, but I think it makes sense, because these are historically low ordinary income rates. If you pull that money out of the IRA now, it's going to reduce your future required minimum distribution. Potentially, if you're rolling it to a Roth, the earnings on that Roth are going to be tax-free for the future. So you pay those taxes now. You do what I call tax rate arbitrage. You're paying more today, so you can pay none later, right? And those two strategies, either taking it into income and spending it or saving it, is fine, or rolling it to a Roth is the other major strategy. So I'd say those things are definitely things to consider, and you need to be using a strategic tax advisor to help you figure that out.
Yeah, people don't realize that once they're retired and they're looking at Social Security for income, their pensions for income, and then going into those retirement plans like IRAs, and let's say they want to put $20,000 down on a car, it doesn't cost $20,000 to put the money down on the car, because they have to pay taxes on the money they pull out. So they're going to have to pull out extra.
Right. Yeah. So they have to consider that. And by pulling that extra out, or, pulling this money forward, you have to be very careful about what that does to your income levels, because there's other levers that it pulls that can be impactful. I know one of the things we want to talk about was Medicare, but that's one of those things that we need to be very careful about.
Well, let's talk about that now, because you mentioned that we should be looking at Medicare, because people may not realize that depending on your income level, how much you make, your Medicare premiums can be different. So we need to be looking at that. You said 2 years earlier. Can you talk about Medicare and the planning around that for those that are looking at retiring? Because you must enroll or at least contact Medicare, or you could end up paying a penalty.
Right. Well, and the thing about Medicare is, as you said, your Medicare premium is determined by the income that you had 2 years ago, not the income that you had this year. So if you're going to take Medicare, next year, it's going to be determined by what your income levels were 2 years before. So you probably can't change that right now, unless, of course, there was a life event. So we're going to talk about that maybe in a second. But when you think about the strategies that we've just talked about, when you pull income forward, you're building up the impact of this year. So if you're not going to retire for 2 years from now and you pull that income forward, it's going to be included in what's called your IRMA calculation. Okay. IRMA basically is the income adjustment for, calculating what your Medicare premium is. And so by pulling that income forward, you could actually be pushing yourself into a higher IRMA bracket. IRMA brackets are different than ordinary income tax brackets. So this gets very confusing. But that's the big thing to understand. If you're, you're going to pay Medicare Part B and Part D, and if you're single or you're married, your normal Medicare premium for Part B is $170.10, and you have no Part D premium. That's if your income is below or is $91,000 or lower as an individual, or $182,000 or lower if you're married. So there's no change in premium if your income's below that. But if you do one of these conversions or you pull that income forward and it pushes you just $1 above $91,000 or $182,000, your premium is going to go to $238 from $170. Okay, so there's going to be an increase in premium. I always talk to clients about the fact that it is an additional tax. Mm-hmm. It's okay to pay that increase in Medicare premium. You might not want to, but when you think about the benefit maybe of pulling those dollars forward, getting taxed at a lower rate, this is going to increase that tax a little bit. But if you're doing large conversions to Roth, the benefit that you might receive is going to outstrip, the penalty, in essence, this little change in your Medicare premium. That Medicare premium will go back to normal eventually. But it's one of those things that you have to be aware of, because you could inadvertently, or your advisor could inadvertently push you into a higher bracket, and you don't want that to happen. Or you at least want to be aware that it could happen. Those premiums for Part B could go up as high as, I think I have the number here, $578 a month, and $78 a month for Part D. So Part B could be as high as $578. Now that's for very high income earners. That would be at the highest level of IRMA bracket. And so that's very unusual. I wouldn't normally see that, but I have seen IRMA payments in the $340 range. The next bracket's $442. So it's impactful on your budget if you're on a strict budget, but I'd say there's cost benefit to that, and you need to evaluate that.
And also, I think it's important to meet with your advisor and have them do the calculations before just doing a Roth conversion, right? Because it can affect your Medicare premium, and you may not even think about that. So
yeah, and that may be fine. Like I said, the benefit you might get is better than maybe the penalty that you're paying, but you just want to make sure that you understand what those impacts are and that you're planning for them.
Yeah, and you don't get a surprise. So
right. That's what strategic tax planning is, right?
Yes, and I know that's what you do, which is wonderful. That's why we have you here. So let's talk a little bit about the withholding.
Sure.
So because if you don't pay enough in on your withholding, then you could end up with a penalty. And so that's another reason you want to visit that before the year end. So can you just address that as well for people and maybe what they can do?
Sure. I think it goes back to organization and tax planning. So you want to be organized and you want to go into a tax planning meeting with your advisor, basically to check to see if you've, considered all the deductions that you can take to try to mitigate or minimize your income. And then check on the income, on the timing of the income flows, because, the tax law requires, as taxpayers, we are supposed to pay in our tax liability evenly throughout the year. And many of us, if we have a normal W-2 job, our W-2 withholding has normally covered our tax liability. But over several years, since 2017, they've changed those withholding tables and they've reduced the amount of withholding, which means we're paying in less towards our liability and we're getting a little bit more in our paycheck. The problem with that is if we have other sources of income that come in, like dividends or 1099 income from an outside job or consulting business or something like that, we may not have paid in enough on withholding, and then we end up with a tax liability at the end of the year. So we owe money. That's never a good surprise, right? And catching you off.
Some of these mutual funds will pay a big year-end dividend that they didn't even know was going to happen.
Yeah, right. Capital gains distributions is usually a big impact. But the dividends, like last year was a very good year in the stock market, and there were a lot of dividends that came out. And even clients, that were planned, the estimated amount of income was lower than what we expected. If we wouldn't have looked at it before the end of the year, we wouldn't have told the client to pay in an estimate by January 15th, which means they would have owed a penalty when they filed on April 15th. So the idea is to avoid penalty. One of the things that you can do is plan ahead. So be organized, work with your advisor to plan ahead. But then the other thing is help the advisor understand when that income came into you. Because while we have to pay it in evenly throughout the year, if the income stream was lumpy or uneven, right? So as an example, you get all those dividends at the end of the year. If you just put in the whole number, then the tax programs assume that you earned it throughout the year, but you didn't. You earned it at the end of the year. So they can make an adjustment in your tax income stream that shows that income at the end of the year and basically can wipe out that penalty because your estimate for that payment wasn't due till the end of the year, right? So it's important to note, to be organized, to talk to your advisor before the end of the year, and to understand any other cash flow to you. When does it come in, and be sure that you're communicating that to your tax advisor if it wasn't earned throughout the year.
And I think this is so important for those people that are retiring, even if they're going to, start a side hustle, let's say, but they're now going to be needing income from things like pensions and Social Security and the retirement plans, because that's when this stuff can get really, really tricky for them.
Yeah, even with 1099 consulting. If you just have an outside consulting business, and let's say you didn't really have any jobs that paid you, or you didn't have checks that you collected in the first 6 months of the year, and you collected it in the last 6 months of the year, well, you didn't earn that money in the first 6 months, and so you didn't owe tax in the first 6 months, but you owe tax on all of it in the last 6 months. You could be faced with a penalty unless you show that those streams of income came after in the second half versus in the first half. So the timing is very important, even for consulting businesses.
Wow. Okay. So that, phew. I know this is getting pretty complicated, perhaps, but I also wanted to ask you about, this the 2017 Tax Act. It almost doubled the standard deduction, and so things like mortgage interest and charitable deductions were affected. So, can you just talk about that? Are itemized deductions really gone? When do they even matter? And for the average person, is it something that they can even use anymore?
Yeah, I think what it really did was it made reporting and tax preparation quite a bit easier for many people. It increased the standard deduction for a married couple to around $24,000 or a little bit higher now. What it also did was it capped. So if you owed or had deductions greater than $24,000, the other impact was it eliminated and actually put in a cap on sales tax deduction, which was, for many people, a big deduction. it reduced it to $10,000. So, there's a thought that this impacted mostly just wealthy clients, but what I found is it actually impacted a lot of middle class clients too, because they're in high sales tax states. They have good jobs. They're not necessarily wealthy, but it eliminated or reduced the amount of deductions that they could take. So they ended up with the standard deduction instead of maybe $28,000 or $30,000 of deductions, which they would have had to account for in their tax preparation. It actually hurt them. But I think the things that you want to make sure is that you've taken advantage of the 401k, 403b, IRA contributions, health savings account contributions. You can make donor advised fund contributions. If you're close in itemized deductions to that 24,000 standard deduction, you can actually take more deductions on top of that, but you can't take the standard and then add all of it. You have to actually either itemize or take the standard. But so if you're not going to make, large charitable, let's just say your deductions are $5,000 normally, unless you're going to make a $20,000 charitable contribution, you're probably just going to take the standard deduction, right?
Right. Well, it seems like that benefited the people who are renting rather than buying as well. They ended up getting some benefit from this. And it seems like now with the houses going up 40%, let's say, because of COVID and all that cash coming in and the market's getting real tight. And then interest rates now going up, less people are able to get into housing that was like maybe once in a lifetime when you could get under 3% on a 30-year mortgage, let's say. But it seems
yes, that's absolutely correct. And the real estate taxes and sales tax are really two of the primary big drivers in deductions, or had been, and they capped that at $10,000. And when you live in Michigan, you know what your real estate taxes are. Mm-hmm. In many communities, they're much higher. Not maybe higher than 10,000, but in combination with sales tax, you would easily get over that $10,000 cap. And so that's the punitive impact of that change from 2017.
Yeah, absolutely. So we kind of hit on this with the big year-end distributions coming through, but I wanted to make sure that even though, the markets have tumbled and come down, people are down maybe 20, even 25% on their portfolios, they still have some tax planning they can do by doing something called tax harvesting, right?
Yes.
Can you talk about that, taking advantage of losses and maybe some of those gains that they're going to be hit with, even though they really didn't benefit from them?
Right. Well, tax loss harvesting is a more complex strategy, but I like to just simplify it and say we do this to make lemonade from the lemons of the market that we get, right? So when the market's down, what we want to do is maybe take some of the losses that have been incurred in the portfolio and set them aside to use for a future gain. Now, we don't take and move out of the market. We basically just exchange one position that's gone down in value with another. So we just exchange that position. So we're still in the market. We're in a similar asset class. It can't be exactly the same investment because there's rules about that. But we take the loss. We are still invested in the market in a similar asset class. So when that market turns around, and we don't know when that's going to be, you still get all the upside. But now you have a loss to take against that gain in the future. So tax loss harvesting is a very important strategic tax planning strategy, and you should be working on that with your tax advisor and your investment advisor to take advantage of it.
Wow. Okay. So write that one down so you can ask about it, right?
Exactly.
Good. Another question is the required minimum distributions, or what people hear as RMD. There's been some changes with those. Can you talk a little bit about that and some planning that should be done around the RMDs?
Sure. Required minimum distribution is what an IRA owner or somebody that's participating in a 401k that's reached a certain age, they have to take minimum distributions generally. That age used to be 70 and a half. Now it's 72. There's some talk that it could be moved up to age 74 at some point in the future. We're not sure, but it's basically the required distribution out of your retirement accounts into your income. So we know that that's going to happen on a regular basis moving forward at some level. And so we can plan for that when we do our 20 to 40 year tax plan. And we can see the impact of taxes on that. So, you have to take your required minimum distributions. If you pass, or when you pass, your beneficiary is going to receive that IRA in a beneficiary IRA, and they're going to have to take minimum distributions over a period of time, and they're going to have it distributed by at least the end of the 10th year. And so one of the things to be aware of is if you've received the beneficiary IRA as inheritance in the last couple of years, there is a required distribution that should be made. There was some confusion about that when the Congress passed this law, and so the IRS is coming out with new rules to clarify that. But the long and the short of it is, if you didn't take that beneficiary IRA RMD in 2021 or 2022, the Internal Revenue Service, they're indicating right now that they're not going to come after you for not having taken it. So you are required to take minimum distributions. There was some confusion as it relates to beneficiary IRAs. That should be clarified soon, but you shouldn't be penalized for a 21 or a 22 missed minimum distribution.
And when someone inherits the IRA, they have to pay the taxes. They have to take the distribution over 10 years. We used to be able to stretch it out over a lifetime and, do planning where you'd be stretch it out over the children's lifetime, the grandchildren's lifetime. That's gone away, right? That's
correct. Yeah. And there has to be 100% has to be distributed, by the end of the 10th year. If you're taking the minimum distribution, you won't have distributed the whole thing. And so there's going to be a big lump sum at the end of that time period that you're going to have to take into income if you're the beneficiary of an IRA. So if you know that's coming 10 years from now, we've just talked about the fact that tax rates are likely to go up. And if you wait and take that distribution 10 years from now, it's likely that distribution is going to be taxed at a higher rate. Does it make sense to pull some of that forward and take some of that distribution now at a lower rate of tax? And my opinion is that yes, it probably does make sense to do some of that, maybe not all of it in 1 year, but you definitely want to make sure you're considering a bracket topic strategy for that beneficiary IRA so you don't get hit with a big tax bill at the end.
Yeah, and a strategy for that is to take the income from the IRA now and let Social Security, if this is where the planning comes in, let Social Security defer until age 70, and you'll end up comparing 62 to 70 with about 76% more income from Social Security. And then when you add all the COLAs, I just did this calculation, it was 108% more taking the Social Security at 70. And that's for life. And it inflates and it's got survivor benefits. So people really need to look at this planning instead of defer everything. And because most people take Social Security at 62.
Yeah,
and then a lot of them get bored and they go back to work, and then they're having to pay back $1 for every $2 they earn. And so all of this is so important, isn't it?
It really is. It's important to have that right advisor, that interpretive advisor that's walking with you on that journey. I like the word of solidarity, walking together in that journey of life, through the ups and downs, and talking about all of these impacts and helping plan for that ideal future.
Yeah, absolutely. So I know we're getting close to the top of the hour. And what I did want to ask you about, what has happened with charitable planning, charitable donations, charitable deductions? Has it changed? And is that something that, that average people can still take advantage of?
Yeah, I actually think this is an area of caution. Because there's been a lot of fraud in the area of, people putting themselves out as 501c3 charities. That's the only deduction that you can take for charitable contributions, is to ensure the organization you're contributing to is on the list with the Internal Revenue Service as a 501c3 organization. So one of the suggestions I have is just go out to Google and search this term, search for tax-exempt organizations, and it'll take you to the Internal Revenue website where you can actually search to determine whether who you're giving the money to is a charitable organization. Check that first, because those are the only deductions that you can take. And once you're comfortable with that, then you can get into the tax strategies as it relates to charities. They have donor-advised funds now that you can make a large chunk contribution to, and we could talk about that as one of the year-end tax planning strategies. But if you've got a lot of income this year that you're pulling forward, you can offset that income and so if you go over a tax bracket, you can actually make a large contribution out of money that has already been taxed, and it will lower your taxable income. maybe get you back under that bracket. And it sets up a donor advised fund that you can in the future direct who to make those charitable contributions to. So you don't have to name the charities that you might name in the future today. You can actually do that later, many years from now. You can continue to make contributions to the donor advised fund this year, next year, the following year, and you can make those contributions over 10 years, 20 years, 30 years.
Yeah, that's pretty interesting. And can the children inherit the donor advised fund and continue to make the contributions that the parents were doing?
Yeah, the interesting thing is it's not really considered inheritance, so it's outside of your estate, which is the nice part. So if as a couple, maybe you set up a donor advised fund, you and your spouse may be listed as the donor advisors. So if one of you passes, the other one continues to be the donor advisor and can make charitable distributions from that fund. But you can also name successor advisor donor advisors. So your kids can be listed, or other people that you might be interested in supporting, a charitable cause over time. You could have an informal board where you've got a list of other charitable donor advisors, successor donor advisors listed. So it gives you some of the benefits, kind of a private foundation, and your kids can make contributions to that fund and take a charitable deduction, because those donor advised funds are 501c3 organizations. And so you can take that deduction this year, but you can make those contributions out over decades.
Right. And they'll make sure that you're not giving money to inappropriate charities.
That's
right?
the nice thing is they actually do that search for you. So once you set one of these up, you could request to make a payment to a different charity, but if they're not on that list, the donor advisor company basically has to figure that out. So you're not bothered with that anymore.
So what a nice thing to do with your family.
Yes, absolutely.
Yeah. Yeah. And that's what these, wealthy families do, is they create a family foundation, and the money passes, generation after generation after generation, because it's not being liquidated each time by taxes.
This works in communities too. So, in faith communities and other communities that support a specific cause, if they don't have the ability or if they don't want to fund that charity with a large chunk in 1 year, they may put it in a donor advised fund, and the community can contribute into that donor advised fund. The individuals from the community can take that deduction, and then the people that are on, in essence, that are the donor advisors can make that direction to those charities over time. It works both ways. Yeah.
Yeah, that's great. Wow. So much really, really great stuff. Is there anything else that you want to add? And I'd love for you to share how people can connect with you again. And also give the name of your book, because we do have a lot of entrepreneurs in our community, and they will probably want to go check it out.
Sure. Well, the name of the book is The Entrepreneur's Guide to Financial Wellbeing. They can get it in the Google Bookstore or through Amazon. They can contact me at wtitus@savantwealth.com. Even though we're talking about tax planning and getting things in order, I think the most important takeaways are to get organized, talk to your advisor, and do some planning before year end, but also take a look at the long view. The long view is a 10, 20, 30, 40 year tax cash flow plan. And if you're working with a tax advisor that is just focused on compliance and not helping you strategically plan for the next 10, 20, or 30 years, find an advisor that can help you do that. Because that's what's going to be most impactful over the years, is to minimize the impact of tax. It's many times it's not about what you earn in the markets, which is important. It's what you pay in taxes and how you can minimize that moving forward.
Oh, that's brilliant. Yeah. So we're going to put that in our Facebook community, those bullets. So thank you so much for being here. It's been wonderful having a smart man on Smart Women Talk.
Well, thank you. Thanks so much for having me, Katana. It was wonderful to be on your show.
Yeah, I really do appreciate it. So be sure to check Wayne out if you need help with your license, like all over the country. So just because we're from Michigan doesn't mean you can't reach out to him. So give your website one more time.
It's www.savantwealth, SAVANTWEALTH.com.
Great. Perfect. Okay. Thank you very much for being here. It's been
Thanks,
great.
Katana.
You're welcome. Okay, everyone. We appreciate you supporting Smart Women, and we want you to make sure you know that you can also join our free community. And all you have to do is go to joinsmartwomen.com. And when you do, you'll get our monthly newsletter, which comes out on the first Tuesday of the month. We'll have information on who our two guests are, because our newsletter is always theme-based. And this month it's about money. Next month, it's going to be about getting rid of clutter and intuitive eating. So go to joinsmartwomen.com. Don't forget to subscribe to Smart Women Talk on your favorite podcast, or you can go to smartwomentv.com and you can watch the show. So until our next show, go out and live with more purpose, passion, and prosperity. Smart Women Talk is brought to you by Smart Women's Empowerment, a 501c3 nonprofit project of United Charitable. Music by Bill Lucas from his album When It Rains. Available on Apple Music and Spotify. Catch us wherever you listen to your favorite podcast, and be sure to join our free community at joinsmartwomen.com to access all our free Smart Women resources.